Will, good morning. How are you?
Good morning, Ben. Good to see you.
Good to see you. Yeah, good to see you as well. How's the weather out there in Boston?
Beautiful, absolutely gorgeous spring day, a day that you're very used to in Colorado and we not so much in Boston.
Great, great. Yeah, we're finally getting some rain here in Colorado. We desperately need it, and that'll be
Oh,
a
that's great.
big topic for today. And we'll give it just a minute here, and then we'll get going. And we will have some time for questions and answers at the end. But good morning, everybody. Appreciate you joining our quarterly webinar here to keep you up to speed on what's going on in the fixed income markets, as well as in the state of Colorado, and provide some tips and tricks on how to navigate the rest of the year for you. Will Goldthwait, who is our portfolio strategist and client portfolio manager for State Street Investment Management, joins us today. He's an integral part of CSLIP, serving our board of trustees, and he's going to kind of kick us off here with a disclaimer, and we'll get going.
Awesome. Thanks, Ben. Yeah. So I do have to read this, so just bear with me. But before we get started, I must let you know that the information on this webinar is intended for the confidential use of CSLIP and State Street and those listening to this webinar, their clients and prospects. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by me and or Ben are our opinions and not that of our respective firms. The comments do not constitute investment advice or analytical research and should not be relied upon as such. And we are recording this on the 27th of May at 10:30 a.m. Mountain Time. Let's fire it up now, Ben.
All right. Well, thanks, Will. It's been a great year, so far. It's hard to believe that we're halfway through. And, we have a couple of different topics today, and I would encourage the audience, if you have questions, feel free to put them in the chat, and we can either answer them real time, or we'll leave some time at the end as well. And we appreciate everybody joining. So, Will, maybe we'll start on the geopolitics topic today.
Yeah, no, geopolitics absolutely front and center, top of the fold, as they say, for those that remember physical newspapers. It is getting tricky. It really is getting tricky. We're watching energy prices closely. I think if you're going to put an item on the top of your news feed, what you want to put up there is when does the U.S. impose export restrictions? For those of you that have, been on our other podcasts, we talk a lot about the fact that there are the energy exporters and there are the energy importers. The United States is an energy exporter. And we are in the very fortunate seat of being able to produce more oil and energy than we can consume. But as the strait remains closed and appears as though it will not reopen anytime soon, we're looking at sort of mid to the end of June for the administration to potentially impose export restrictions. That is going to be a clear signal that energy prices are going to remain higher for longer. I think the president has done his best to try to start this war and finish this war as quickly as possible. He was very focused on eliminating Iran's nuclear capabilities, and he was hoping, I think, in my opinion, he was hoping to start some sort of a revolution inside that organization and put a government in place that would be friendly to the United States. That is just not what's happened. They've dug in their heels, they've become defiant, and they've used really the one wild card that they had, and that is closing the strait. So that's 20% of the world's energy that flows through that, and now with that closed, it's really causing a real jam for a lot of folks. So yeah, happy to keep going there, Ben, but maybe I'll just see if you have a follow-up on that.
Yeah, I mean, it's real noisy out there, from everything that we're being bombarded with, pretty much every single day. I guess kind of what are some of the developments that you're seeing that actually transmit into rates? credit and liquidity of public funds for local government investors. I mean, what are you seeing?
Yeah. That is just, it's so, the market has been very, very interesting. Volatility's ticked back up. When the war started, immediately there was this knee-jerk reaction that said, okay, if you cut off 20% of the world's energy supply, that will have an inflationary effect. But that inflationary effect could potentially also create demand destruction, right? We know that each of us, walk into the world every day with a dollar in our pocket, and that dollar is divided into certain segments. You need a certain amount of that to buy food, certain amount to buy energy, pay your rent, et cetera, right? So if those energy costs went from 20 cents of that dollar to 30 cents, that means you have to take that 10 cents away from something else. That's demand destruction, right? So the higher energy prices create that demand destruction. So what we were thinking we would see is we were thinking that the inflation effect would take care of itself. In other words, higher energy prices creates demand destruction. People cut back, people pull back. They don't have that additional discretionary income. And so the whole economy slows. But what we're not seeing that right now. In fact, we're seeing the consumer that's been stressed, but we're not seeing really the slowdown in the economy. In fact, one thing that happened after the first quarter was we saw an earnings cycle that looked incredibly healthy. We saw this tech boom, this AI build out, this data center build out that was really giving legs to the economy and providing a lot of stimulus into that economy. And we see that in the debt market. There's been an extraordinary amount of debt that's been issued by those major companies in order to fund that build out. If someone's borrowing money, right, that's somebody else's revenue, right? One person's debt is another person's revenue, and that's very important to remember in the context of government spending and in the context of capital expenditures. So we're seeing a massive CapEx cycle. And so now what we have is an environment where the market is starting to recognize that that the administration is not going to be able to end the war quickly. They are not going to be able to reopen the strait quickly. We've got a CapEx cycle that's accelerating. We've got a healthy economy that's growing. We're not cutting rates. Rates are going higher. That's what the market is saying right now. And we'll talk about what our chief economist Simona Makuta thinks about that, but that's what the market is telling you right now. We got 2-year notes above 4%. We've got 10-year notes almost at 4.5%. We've got 30-year bonds over 5% right now, granted just barely over 5% today. Those are huge moves in yields over the course of the month of May, and that means interest rates are higher. That's going to do some of the inflation work for the Fed, right? So the Fed still has policy rate at 3.5, 3.75. But those higher yields are going to do some of that demand destruction for the Fed. So the Fed is in a really tricky place, probably never trickier, in my opinion. So there's a lot to talk about there.
Yeah. Well, maybe we can kind of shift over, there a little bit and talk about the new Fed chair, coming in. That's obviously been a big topic there, with Kevin Warsh, and May 22nd, which was my 21st anniversary of graduating college. I don't know where those
Wow.
21 years went, but anyways, what do you think matters the most in the markets from that leadership change? The person, the committee, communication style, what do you think is, really significant about this?
Yeah, Kevin Warsh has really got a very, very difficult job. So just to remind the audience, I know we've talked about it a little bit, but just to remind the audience, the chairman of the FOMC, of the Federal Open Market Committee, that job is all about bringing that group together. So it's not really about that person's vote. It wasn't really about Chair Powell's vote. It wasn't about Janet Yellen's vote, Ben Bernanke's vote, Alan Greenspan's vote. Those are all former chair people of the FOMC. It's much more about their ability to bring the other 12, or excuse me, the other 11 voting members, but then there's total of 19 members. There's non-voting presidents of the FOMC that rotate through on one-year terms, but it's bringing all of those people together and syncing up and trying to put together a cohesive message that comes out into the market. So Kevin Warsh is going to be walking into a group of economists, and these are all PhD level economists. In fact, I think Chair Powell was the only non-PhD economist on that committee for quite a while. He's walking into a room where he's got to bring a lot of people's voices together and sound cohesive. Now, let's remember what happened at last month's meeting. They had 4 dissents. Stephen Mirren, who was the Uber dove, he wanted lower rates, lower rates, lower rates. Now recall, he's gone. He's off the committee now because Chair Powell is now no longer chair, but he decided to stay on until his term is complete in 2028. And then the other 3 dissents were actually those wanting to remove the easing bias. That's very important to think, because what that means is we're not easing at all now, or in fact, we're possibly raising rates. So what we expect at that June meeting is that Kevin Warsh at the presser will release a statement that essentially says they've removed the easing bias, and they will hint at this idea that the persistent upward energy costs are giving them more concern about inflation. And I don't think he's going to say anything about raising rates, but he's definitely going to remove any speculation about the potential for cuts. And so I think the market right now is essentially repricing that. And when we look at Fed funds futures, which is granted, it's a data point in time and that can move dramatically, but it's showing 125 basis point rate hike priced in by November of this year.
Wow.
So there you go. That's what the market's thinking right now. And with 2-year notes at 4%, and Fed funds effective trading right around 460, that's a steeper curve, and it's showing that the market thinks that the curve is going to, that the Fed is going to potentially raise rates. One last thing. The sell-off in the market has really been at the front end. So 2-year notes, 3-year notes, 5-year notes, so it's what we call a bear flattening, which means that front-end yields moved higher than back-end yields. Now the whole curve moved higher, but front-end yields moved more higher than back-end yields. And that is an indication that the Fed's got a little bit more wood to chop here as far as squashing out inflation. But ultimately, the inflation dragon will be slain, and that they will get it under control. So the back end of the curve, selling off a little bit, but not dramatically, is a good indicator that the market does feel confident that the Fed will get the inflation dragon slain, but it's just going to take a little bit of time.
What a monumental shift from our webinar back in October, November, right? We were thinking 3, possibly 4 rate cuts. I know that one of the big institutions out there was planning on 5. Everybody was all over the place on what was going to happen, and now there's 0 and possibly a rate increase. So, well, it's interesting. I mean, it's kind of a double-edged sword for local governments, right? They're a lot of them are in the budget cycle right now, and I've had multiple conversations recently about a nice conservative number for interest income for local governments, and it's factoring in these 2, possibly 3 rate cuts, and people may be looking pretty good on what their interest rate forecast was, because I was recommending 2.75 to 3%, and I think we'll probably do a lot better than that. So it's interesting, to see what's happening out there, and it shows that things can change quickly. And I think that that's where liquidity, these days can be a very valuable tool. So, kind of around that economy, I mean, what do you think the biggest surprise risk for the economy is in the second half of 2026? Given
Yeah,
everything that you've mentioned today.
yeah, I will say, from an economic perspective, my personal opinion is the CapEx AI spend cycle. That's the thing that I think could change. Well, as we know, all new technology has a period where there's an enormous amount of capital expenditures, right? If you go back and look at the internet, you look at broadband, you look at um, computers, mainframes, desktops, go back, look at automobiles, look at trains, look at canals. Like any time there's new technology in the marketplace, there's an enormous amount of capex, but ultimately there's an overwhelming amount of capex and there's some sort of a bubble or some sort of a reprice, right? We saw this most recent history, we saw it in 2001 after the Y2K build out, as the internet was trying to figure itself out, as broadband was trying to figure itself out. Um, we saw, the spending start to slow there and ultimately cause that 2001 recession. You go back in time, you can look at any number of different build outs that create these boom busts. So where are we in that cycle? I don't know. But that is, the concern that I would have for this economy because we can clearly see that all of that borrowing and spending is having a real impact on the national economy. And the national economy looks very healthy right now, even though we see consumer spending is stretched. That national economy, that K-shaped economy, the top of the K, they still seem to be spending, all those boomers taking their grandkids to Disney. But let's just pivot for a second, Ben. Like, so that's on the national scale. How are you seeing Colorado, whether it's at the local, I know it was a super tough winter. How are economies in Colorado doing right now?
So great question. When we went back to kind of the fall in putting together the business economic outlook with the University of Colorado, specifically on the local government side, a lot of the data that was coming out towards the end of the year was forecasting a pretty significant slowdown here in Colorado. And that is the case. Compared to the national economy, Colorado has slowed dramatically. And really where we're seeing that is flat to barely above last year's sales tax numbers at municipalities, right? There's been a huge reduction in sales tax in some of the mountain communities that rely on heavy snow years, which we did not have a heavy snow year. We've had a lot of moisture recently, but it's going to be no impact on how low our water levels actually are and what we're sending downstream to our neighboring states through the Colorado Compact that was put together 100 years ago, right? So I think some of the biggest problems that we're facing. The tale as old as time right now is always housing. Housing is extremely expensive. There's a big migration of money moving around. You mentioned that K-shaped economy, right? Where the top income earners are still doing what they're doing. But, I think with that dramatic shrinking of the middle class, it's very hard, for not only local government finance officers, but when you get into school districts with teachers, all these people that we rely on to teach and to hold these positions in these communities, like Aspen, Telluride, and Steamboat, in some of these areas, Summit County, right, where it's a lot of those communities are transitional, where you have people either coming in or out, temporary workers, or you have permanent residents, right? You also have people that are there for a week or two out of the year. And when you have a low snow impact year like what we had this year, that really has a very high trickle down effect, not only in those communities, but I like to refer to it as downstream. Usually the further you head down the river is where the more affordability happens, right? Agriculture on the Eastern Plains is slowed, lack of water, right? There's a common impact here. And really what we're seeing is there's a lot of fire protection districts out there that are very nervous about what this year is going to look like all over the state. And I think that extends past Colorado, right? I think the entire West in a historic drought right now is really a big impact. So there's a lot of things. I think Colorado is still faring okay, but we've definitely regressed from being one of the top 10 economic states in the country to now being in the top 50% in the country. And really, you know, the local government side as well as professional services are what's carrying the economy right now. Energy has obviously, you know, been a big impact as well. So, you know, I think that there's a ton of uncertainty, but Colorado fared so much better than the rest of the country for so long that maybe some of these impacts that we've seen over the last couple of years are really starting to catch up now. But property tax valuations, you know, on the county level haven't had significant fluctuations. You know, I can speak for Denver. My last assessment was 55% higher than the previous one, and I think this
Oh,
year it
wow.
was, you know, less than 5%. Yeah, it's been a challenge, you know, and I think some of these rural communities where there was moratoriums on some of the property tax collection for education, as well as some bills passed at the state legislature are starting to creep back in now. So there's still a lot of that sticker shock going on. So I mean, that's kind of a, you know, a high level overview of some of the big challenges out there. But we are starting to see population increase. There's a lot of migration out. So it's we'll see what happens over the next 12 months. But am I concerned about the Colorado economy at this point? No. But is it on my radar? Yes.
Yeah. Well, I will speak at the national level. We are seeing some breaks in rents. So rents are a pretty good indicator on the health of the economy, and we are seeing vacancies up and rents coming down. Now, you know, sometimes people are like, what are you talking about? Where are you seeing that? Sometimes people get very frustrated when I make that comment, and it's national data. We look at both owner equivalent rents and Zillow data. And we can see, we hear anecdotes, we hear anecdotes that, some apartment building is willing to offer the first month free or something like that. So the rental market has been softer, but what's happened in the owner's market is there's so many people that are sort of my age and older that own their homes outright. And so they're just not selling, they're not buying, they're not doing anything. They're staying right where they are. And with mortgage rates now in the high sixes, that's been a real challenge. And it's something that we know young people are shouting from the rooftops over. And that's why you see, political movements like we've seen in the city of New York. Where they want to be able to rebalance. And I was listening to a local Denver economist when I was out there 2 months ago, who was saying that Denver is now right up there with the more expensive cities in the nation, because it's just been such a popular place to be for 30 years. So it's a real challenge. So when you talk to the local treasurers, like how are they going to close that budget gap? Is it spending cuts? Is it borrowing more? Is it, looking for new sources of revenue? Like what are people talking about as far as, closing those gaps?
It's really all the above, right? And luckily, some of the communities around the state are faring worse than others. But again, it's not at a catastrophic level yet. Some of the counties that we work with and that we've talked to have seen huge budget deficits, right? And really finding ways to either be more fiscally conservative, but also debt issuances are starting to pick up. And I'm wondering now, because at the beginning of the year, there was an expectation from some of our strategic partners out there that are municipal advisors, as well as underwriters, on all different sides of the balance sheet, that this was going to be a really high issuance year. And last year, what we were hearing was kind of average deal rate was up anywhere from 15 to 20%. And I don't know that that's going to continue this year. It'll be interesting to see if there's a flood to the market of a lot of local governments trying to issue debt to carry on these capital projects. But, Colorado's weathered a lot of storms before. Well, these are some of the issues that are being talked about around the state. And, we are going to have some political turnover this year. Who knows what that's going to look like, right? I kind of focus my energy on city and county of Denver stuff when it comes to politics. But, really at the end of the day, I think that it's going to be a challenging environment, but we're not seeing the huge budget deficits that we saw going back 15, 20 years ago, right? That was a much different landscape than what we're in now. So we're just now starting to compile a lot of the data. I know that the University of Colorado is going to be reconvening here in about 6 to 8 weeks and kind of kick off the new outlook. So our future webinar, hopefully I'll have more of a barometer, but that's kind of some of the big topics that we're hearing out there. And, I guess for you, it might be a good time to kind of shift into some more strategy, some more, what we're seeing value in the fixed income marketplace. Do you want to start on fixed income or you want to start on liquidity?
Well, I'll just dovetail off your comments on the municipal debt issuance side.
Yeah, please.
The capital markets are still very healthy, very receptive to new issuance. Deals are getting done. Demand is there, and pricing consistency is there as well. So from the time of issuance, so from the time of announcement to the time of pricing, markets are grinding tighter. And even with this rate sell-off in the investment grade space, we saw credit spreads tighten. In other words, just saying, hey, there's an absolute level, there's an absolute yield level that we like here. And in the front end, we think there's value in some short corporate paper. No, but we're being cautious. We're being
Yeah.
cautious because we feel as though things are priced to perfection. So we like treasury yields here. We like buying these higher yields, although we've moved our duration positioning to neutral in the funds, just given this sell-off. And then in the money market funds, there's a lot of different ways to position those portfolios. So in the liquidity pool, we're definitely keeping our durations extended a little bit, but we're doing it in a very strategic way, buying 2 months, 3-month paper, maybe
Mm,
4-month paper, not buying 6-month, not buying 9-month, not buying 12 months. Recall, we've got a 60-day weighted average maturity cap on these funds. So I can load up the fund with 2-month paper and be at my duration max. So that's just a testimony to how safe and liquid these funds are. So that's how we're expressing our view in the portfolio now. We are still leaning a little bit long duration, but we're doing it at the very shortest end of the curve. So once we hear Kevin Warsh speak in June, we can then make a determination on what does that picture look like. Certainly if his talking points at the presser end up being more hawkish, more bearish, from a rates perspective and we see yields move higher, perhaps he indicates that, they really do need to make sure they squash out the inflation bug that's in the market, then we'll be positioned accordingly, right? That 2-month, 3-month, even 4-month paper will roll down the curve nicely. We'll have opportunities to buy higher yields. And we've seen a massive twist in the curve just over the last couple of weeks because funding rates, repo funding rates have declined, and back end of the curve has gone up. So we've seen sort of a twist in the curve, which has been really interesting. So we've used the opportunity to extend, like I said, into that 2, 3, 4-month part of the curve, and that's been offering really good value for the clients of CSLIP.
Oh, that's great. That's great. So I think it's probably a safe statement to say you guys are keeping your powder dry.
Yes, indeed. We are very much doing that. We're belt and suspenders type people. So we want to make sure that we have safety and liquidity is absolute top of mind. And like I said, there's a lot of different ways you can structure a money market portfolio to perform well in all markets. And so right now, this is definitely the right way to position this portfolio. It feels good just knowing that there's so many different moving parts going forward. I'll just talk a little bit more about the labor market because I'm going to say
Please.
something now and everyone's going to be like, what are you talking about? Our chief economist, Mona Makuta, she did our monthly economics meeting this past Tuesday. Sorry, a week ago Tuesday, not yesterday. And she's like, I don't have any confidence in my call for 2 rate cuts this year. So
Wow.
she hasn't changed it, but she has no confidence in that call now. So what that is essentially signaling is at the next quarter end, she updates that forecast on a quarterly basis. So what's that signaling is that at the next quarter end, she's going to revise it.
Hmm.
But the reason she's been hanging on to that call for so long is because there are underlying weakness. There is underlying weakness in the employment market. So it's taking people longer to find work. It's harder to find work. There's still jobs being offered out there, but oftentimes it involves moving, or it involves long commutes, or it involves, underemployment. If you were at this level, but the job that's being offered is down at this level and you have to take a salary cut or some sort of responsibilities cut, that's considered underemployment. So with that has been her number one theme. That's been the thing that she's focused on the most when it comes to her overall economic outlook. Now, the Fed is not focused on that. I mean, of course they are, but that's not their primary focus. Their primary focus is inflation. Why? Because inflation is the side of their mandate that they've been failing on. So it makes sense. Like we have not got the inflation thing right. People are very upset and hurt by higher prices. I don't have to tell anyone that on this call. It hurts. You go to the grocery store and you're like, wait a second, what did I bought a stack of bananas and some oranges and it was $200. So, that hurts. Now we're going to the pump. That hurts. Everything is costing more money. And so the Fed is keenly focused on that. So they're willing to take the hit on the employment side, on the labor side. And so this is just a differing of opinion, right? You've got the Fed officials over here. Simona has her view here. But from a market perspective, we are absolutely positioning the portfolios for higher rates right now. So
Good to know.
that's how we're positioning the portfolios, and that's what we think. Did I answer your question, Ben? Now I forget what your question was.
Well, you answer my questions in many ways, buddy. I
All
appreciate
right,
it. And
cool.
I want to take a quick pause there because we had some feedback coming in from one of our county treasurers actually,
Oh,
and
nice.
he's mentioning that the threat of lack federal spending on social programs were kind of a key driver, and is more worrisome for Arapahoe County and more of a drag on spending than budget shortfalls, right? And I think that makes complete sense, for some of the larger counties out there where some of these programs are really reliant, right, on what it
Yeah.
looks like for them from an economic standpoint. So a quick shout out to Treasurer Westerberg from Arapahoe County for providing that data for the call here. It's great. Okay, so kind of a 2026 question for you here. If you had to give one rule of thumb for liquidity management in 2026, what do you think that is this year? Because I think that that's really what this audience can kind of take away from this, aside from all the economic data and information that we gave. What do you think there?
Yeah, one rule of thumb for liquidity management this year is anytime the uncertainty side of things ticks up, like the variability of outcomes ticks up, that's when you start to, circle the wagon, so to speak. That's when you start to get closer to home. So just as I was describing before, loading up in 2, 3, 4 month paper rather than 6, 9, 12-month paper. It's, you know, the Fed is in a particularly tricky spot right now as far as liquidity goes. The Treasury is having to issue a lot of debt. They're having to issue a lot of paper. That is all piling into the front end of the T-bill market, because that's really the only place Scott Bessent, the Treasury Secretary, can issue that paper. Is he's got to load it up into the front end because the back end can't take it, right? If he starts to load paper into the back end of the curve, then he's going to end up having rates much, much higher. So he's had to just pummel the front end of the bill market. And my quarterly market outlook, which I'm happy to reshare with you, and you can. Sorry, I'm happy to send it to you again, and you can share it with the audience. It just shows the amount of bill issuance that's been done. It's absolutely mind-boggling. And so when I think about liquidity, when I think about safety, I think about just getting a little bit closer to home. Here's something that's interesting to consider. Kevin Warsh is not a big fan of all the forward guidance and the press conferences and all this like transparency that we've grown
Yeah.
accustomed to over the last decade plus. So it's quite possible that he makes some changes. It's not going to happen quickly or soon, but it's quite possible. Maybe he removes the dots, right? Maybe he removes the dot plot. Maybe he removes this summary of economic projections altogether, right? And so all of a sudden we go back to sort of the Alan Greenspan era where we just didn't know what the man was thinking. Maybe they take out press conferences, right? So Kevin Warsh doesn't have to stand in front of the press corps and answer questions after meetings. So this is all going to be very interesting. So what does that mean to me? It means there should be less risk taking in the market because you're not hearing, like if you recall back in the day of Alan Greenspan, they used to watch him, they used to film him going into the FOMC meetings, and depending on the thickness of his briefcase, if his briefcase was thicker, it meant that they were going to raise or lower rates. They called it the briefcase indicator. But this is it was very much a guessing game back then. And so when you are not sure on what's going to go on with the Fed and markets, then you just take less risk. So, the one thing that I would be thinking about if I was a corporate treasurer right now is like understanding your risk, understanding where your pinch points are, and then being prepared for any type of event, because I think 2026 could see any type of event from geopolitical. We got elections coming up in the fall. We've got an enormous amount of debt. We've got an AI super cycle that's going on. There's just any number of different things that could affect this market this year. And so I think getting a little bit closer to home makes good sense.
Oh, that's great. That's great, Will. And it's been kind of an unprecedented year for CSLIP so far. We're almost 2 years old in terms of taking public funds, and I think today we passed 920 million, which is just remarkable to think about. And looking at the portfolio out there, we get a question a lot about where's the yield, and you seem to be trailing some of the other funds out there. Well, I think you hit on some of those reasons, right? We're not necessarily swinging for the fences, really having lower allocations in commercial paper, really focusing on that safety and liquidity, and high repos, high repo concentration in the portfolio, right? Keeping that powder dry, like what we talked about. But I think the growth is something that we did want to mention today. That well over 900 million. We want to thank all the participants that have helped us get there, in 2 years. And, there was a lot of thoughts, both positive and negative in the marketplace 2 years ago when the board of trustees said, hey, let's take what's already working and make another approach. So I think it's, quick to mention. And, something that I think is very valuable for local governments here in Colorado is to look at cash flow, look at not only your bonds that you have, proceeds, where are those invested, but looking at critical cash flows. Right now, counties are very cash flush, where school districts may not be so. And really, it's kind of that inverse relationship there. So really, leveraging resources, like my team here in Denver, leveraging State Street, right, through these quarterly economic updates. And if you want to speak with our State Street team, you're more than welcome to reach out and we can coordinate that. But at the end of the day, keeping that powder dry, knowing how far to go out the yield curve, and I guess that's one last follow-up I have for you prior to opening up to the audience for some questions. If local governments here in Colorado are going out the yield curve outside of liquidity funds, where are you seeing that sweet spot in the marketplace right now with agencies, treasuries, all the allowable securities under 2475, 601?
Yeah, treasuries, absolutely. Treasuries makes really good sense right now. 18 months, 2 years, buy them, roll them down. That makes a ton of sense. With that said, I know it's difficult for some folks because they've got small teams and they don't have the credit staff, but looking at some high quality agencies, Fannie Mae, Freddie Mac, Home Loan, Farm Credit can make a lot of sense. Looking at some supranationals, TVA Authority, et cetera, or even looking at some really high quality household name corporate bonds. I'm talking the Apples and the Microsofts of the world, the real AA, rock solid names. Buying those shorter dated and rolling them down the curve is something that we like. That's a trade that we like. I obviously know many municipals, buy and defease future liabilities. And so the thing that I tell folks is just be a little bit cautious about how you're putting that money to work. As I mentioned, there's an enormous amount of T-bill supply coming into the market. There's an enormous amount of treasury supply coming into the market. So we always warn people it probably makes sense instead of buying everything on Thursday, maybe buy a little bit on Tuesday, buy a little bit on Thursday, or maybe spread it out instead of buying everything at the end of the month or on a particular day. Spread those purchases out a little bit. I think the last couple of trading sessions have been a really good indicator where we've seen some pretty significant yield moves. And so that's just essentially dollar cost averaging in, right? And not trying to pick the top, not trying to get super clever, but just being methodical in your process. We have a real investment process here where we look at a whole number of macro factors, and then we couple that with looking at a whole number of micro factors before we tactically invest for the portfolios. So I just would always encourage people to be a little bit more disciplined about how they're putting that money to work rather than just buying a slug on, the 15th of every month, because there's a lot of news flow that can disrupt things. And so it's worthwhile taking a look.
Oh, that's great, Will. And we've got a few minutes left here. I don't know if people wanted to submit a question on the chat. We're happy to address it if we don't see a question come in the next minute. I've got one question that I always ask Will on these podcasts, and we're going to keep these going. As the board appointed administrator for CSLIP, it's very important to this board of trustees as well as my staff here in Denver, serving as the administrator to provide information, continuing education, right, and transparency, right, of exactly what's going on out there. So kind of okay, so we got a question come in. I've heard that banks are trying to offload these huge data center loans, or at least the risk within those loans. Have you heard the same? And what does that mean for a potential AI bubble? That is a
Yeah.
fantastic question.
That really is. It's a great question. Yeah, and that's something that we're keeping a really close eye on. So, yeah, so full stop is that the banks can't take all of this leverage, right? They've got a new regulatory regime in play and they simply can't. And so what the words you're hearing now are private credit. Private credit is what is absorbing a lot of this build out. And then the public markets, right? There's been, enormous debt issuance by these giant companies, Microsoft, Google, there's a whole Oracle, there's just billions and billions of dollars of issuance into the markets. And that's something that we're keeping a really close eye on. Banks on the whole, particularly the globally systemically important financial institutions, or GSIFIs as they're affectionately referred to, we don't see any real challenges with those institutions. Post the financial crisis in 2008, 2009, we had a whole slew of regulation that has really taken risk out of those institutions. So much so that this current administration is trying to loosen some of the restrictions a little bit more, but leverage ratios cut to a third, liquidity requirements, leverage requirements. There's a whole host of things that essentially don't allow the banks to lend the way they might have pre-2008. And so that's why we've seen an enormous push into the private credit space. The one thing I will say on private credit is don't throw the baby out with the bathwater. So there's a lot of variation between what is issued in the private credit space. There's stuff that's junk, right? There's stuff that's very risky, triple C rated or single B rated. I mean, really stuff that's very much high yield like. And then there's stuff that's super high quality, rock solid, very well collateralized debt, and there's every iteration in between. So, all of these news sites really want you to click on their story when they hype up, oh, challenges in private credit, challenges in private credit, but there's just an enormous amount of variation between private credit. So you really have to dig in there and see. So in summary, don't see challenges with the banks. Not to say that there's not going to be idiosyncratic problems. Yes, there will be. There will be, the next First Republic. There will be the next Silicon Valley Bank. Absolutely. I mean, those situations will happen. There will be banks that get into trouble, but overall, from a systemic standpoint, we don't see those challenges. And then in the private credit space, yes, there could be some challenges, but you really have to dig in and you have to look at those deals.
All right. Well, we got another question, which is public pension plans seem to be putting more money into that private credit market. So if banks are putting this extra risk in the private credit market, should pension plans stay away from the private credit market? Another great question.
Yeah, absolutely. And that's another great question that really, what type of private credit are they buying, right? Are they buying, the higher quality stuff, or are they buying the juicier stuff? And so that's really that's the question. I can say as far as the pension funds that we manage money for, who we're talking to are being very discerning about what risk they're looking for. So as an example, I said earlier in the call, we don't see a lot of value in the investment grade corporate bond space. We see value in owning some of the highest quality, most liquid names in that space. I talked about buying Apple, rolling it down the curve, Microsoft by rolling it down the curve, but we don't see a lot of value broadly across that. We do see value for those funds that and strategies can do it in high yield, because there's a lot more return in high yield. And there's been some opportunities for us to enter that market. But those could be very different mandates, right? You could have a investment grade strategy, you could have a high yield strategy. So I just don't want to confuse people and think that, oh, we're loading up on high yield. It really depends on the strategy, but we do see, for those strategies that can take it, we do see value there.
Excellent. Excellent. Well, I don't see any other questions coming in, and we are right at time. So, Will, I can't thank you enough. I cannot thank the participants and the board of CSLIP enough for our continued growth. We will be placing this webinar on our website, and we're going to continue to do these. So we appreciate everybody reading these, attending these, for the questions. Thank you in a lot of ways. And Will, I look forward to seeing you hopefully here soon.
Yeah, absolutely, Ben.
Enjoy the summer months out there, and we'll get the next webinar scheduled, and we'll reach out to everybody with the next date, probably in the next couple of months. So thank you again, and I would encourage everybody to reach out to my team here in Denver. We're here to help you, refer resources. If we can answer questions or take a look at cash flow, investment policies, we're only a phone call away, so feel free to reach out at any time. And Will, do you have any other disclaimers or last thoughts for us?
No more disclaimers. No last thoughts, Ben. Appreciate you having me on, and looking forward to the next one.
All right, sir. Take care.
All right.
Thank you, everybody.
Cheers. See you later. Bye.